Thank you. Good afternoon to everybody. And it's always a tough task to take 15 minutes and add real value to this beautiful audience. I would like to obviously thank Bala a lot for that beautiful video that you just saw of the value that we add to our investors. And I'm sure that almost all of you, some story like this of the effect that you have on your investors. You've heard most of the stalwarts speak about India, the opportunity, and all of the rest. And my job today is going to be bringing it all to the ground and sharing with you certain perspectives that might change the way that you think about our business. How can we make ourselves more stronger? And how can we probably leverage all of this growth that is coming ahead of us? Are there things that we need to rethink? Are there things that we need to reset? Are there things that we need to innovate so that we may prosper? So let me dive straight into it. And as most people you would know that in the science of financial advisory that we do, chemistry is more important than math. You saw a beautiful video and you saw the chemistry the client really has with his customer. Now, I want to take you very quickly through a short history of our profession, because without knowing that, we will not be able to really, truly appreciate where are we headed. And I want to tell you that mutual funds started in 1924 in the Massachusetts Institute of Technology when Edward Leffler started the first open-ended fund. After that, you had Harry Markowitz in 1952 write his first paper called The Portfolio Theory. Ladies and gentlemen, if we are all sitting in this room with a profession, it started with this one paper of portfolio theory, which is where asset allocation and asset optimization started. After that, you have people in 1963, John Keeble was the first advisor who wrote the first financial plan. So you can see after 1952, it took about 11 years for the first integrated financial plan that was written. Then you have people like William Sharpe, you know the Sharpe ratio, who had the capital asset pricing model. You had Eugene Farmer, again, Farmer ratio, efficient market theory. Today, fund managers all across the world use these two principles largely when they're constructing portfolios and investing our investors' money. In 1970s, also, you had Wells Fargo, where William Faust started indexing. You had the first graduating class of CFP in 1973, Morningstar started the value and growth style box in 1992. You had Nate Most at Amex, who started the first ETFs. And then in 2002 and 2017, Daniel Kahneman and Richard Thaler both won Nobel Prizes for behavioral economics. That is the history of our business and our profession. It moved from portfolio theories to behavior theory. And to me, 90% of the people I meet in advisory is still stuck in portfolio theory. There's 10% of people who move to behavior theory. They know it intuitively, all of us know it intuitively, but we don't take the real steps to actually move to that direction, which can be far more impactful for our customers. So with that little history, let me take you through a couple of lessons which I think are extremely important at this point to think about. This first one is one I believe that as an industry over the last 30 or 35 years, we have not fully appreciated. And if we can appreciate it, we'll change the dynamic of this industry and this business, which is that most people are in our industry sell focusing on returns, and no harm in that. Investors are focused on returns. But in similar industries, people sell based on units. Now, you have to just think about this. Every investor here in this world, and especially here in India, for hundreds of years, you've been buying gold, you've been buying real estate. How do you buy gold? You buy it in grams, you buy it in tolas, and so on and so forth. How do you buy real estate? You buy it on square feet or square meter or acre or hectare. How do you buy mutual funds? You buy it on returns, not units. The human brain is wired to think about units, but we sell based on value, based on returns. Can you imagine returns can go up or down, but units never go down? And now when you think about this powerful concept of units and to know that investors are already wired on it, if we as a community can bring about this change in the way that we sell or engage with our customers to say that you're buying units, collecting units of good quality companies, all AMCs, they're regulated, they're transparent, they're professional advisors. Just keep buying units, collecting units that you know that you do with gold and real estate as well. What will happen? What will happen is every time the market goes down, your customer will come to you to say, let's buy more. When the performance of a good fund goes down, you will still say, okay, that's at a discount, let's buy more. Do you know what the Prime Minister of this country has been talking about as far as mutual fund advisors, distributors, and the industry is concerned? That we are now standing hand in hand with the foreign investors because of SIP. And that's the singular biggest victory of our industry. Ladies and gentlemen, what does SIP do? SIPs buy more units when the value is down and less units when the value is up. That's what it does. And when you get a focus around units rather than value, that's the magic that you can change in this industry. By the way, 30 or 35 years ago when this industry started, what was the name of this industry? The Unit Trust of India. So that was the start, but somewhere along the way, we've just got focused on returns, 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 and we keep running on the treadmill to help our customers to get the best returns. Whereas when you go into a mall and you see the best product on discount, you're going to walk in and try to see whether you want to buy it. But when products are going up in price, you end up buying that on the mutual fund side and not the other way around. So I do think that there is a fundamental opportunity for us to think of our industry as units that all of us as manufacturers are doing, you as advisors are advising on, and get customers to build on it. Returns can go up or down. Units never go down unless you're redeeming. Let's look at lesson number 2. In the equation of creating wealth, which for retail investors is savings into returns, most people focus on the rate of return. Higher the better. But more wealth can be made with a focus on the savings rate. Because helping clients increase their savings rate can create more wealth even with relatively lower returns. Let me show you an example. If you have a customer whose savings rate is 10% of their income and is getting a 6% return on that, 10 lakh investment over 10 years would be something like 18 lakhs, or after 20 years, 70 lakhs. If you double the returns and keep the savings rate the same at 10%, and you're now getting 12% returns, your amounts are 25 lakhs and 1.29 crores. Fantastic. But let's look at what happens if you double the savings rate. If your savings rate is 20%, but your returns is just 6%, the corpus at the end of 10 years is 37 lakhs and 1.4 crores because more money is put into compounding for a longer period of time. So while we have built this business on an average 2,000 to 3,000 rupee SIP, ladies and gentlemen, if you can get clients to increase their savings rate, even if the returns are smaller, you will create more wealth for your clients. So focus not so much on the returns, but help your clients focus more on their savings rate. Doubling the savings rate translates into better outcomes. Let's look at lesson 3. Beating a benchmark is always a gold standard. But for whom? It's for fund managers. Because you have as many funds, and each fund needs a benchmark. But for advisors, you have to have many benchmarks based on return required for each of your clients' goals, which essentially means as many clients, that many benchmarks. So we've all been used to sticking around and talking about the benchmark. It's important for fund managers. It's not so important for advisors because every client will have different goals and the rate of return you require for that client to reach that goal is your benchmark. Therefore, every household will have a benchmark. Now, to just illustrate that example if a client has 4 lakhs, needs 10 lakh in 7 years to upgrade the car, requires a 14% annual compounding. If you look at Scheme A, and you look at the returns of, minus 22, 17, 25, 30, 185, minus 47. Scheme B, much lower, minus 4, 25, 10, 6, 20, 99. The fact is that Scheme A would have given just 11.8, whereas Scheme B would have given 16% return. And you would have reached the goal with a scheme that has actually lesser upsides and downsides as well. And therefore, the sequence of return risk is something that's important for people to know. And your 4 lakhs will grow to only 8.7 in the first example, even though the returns look fantastic, and you're likely to have customers having shifted out of one fund into this fund when it has been doing great in any particular year, but you won't reach your goal. Lesson 4, in the beginning phase, an MFD will usually want to be, something to everybody. But when an MFD wants to build scale, you need to be everything to somebody. Focus on client segments. And why is that I'm saying? The attitude to wealth is generational. You have people in the baby boomer generation, Generation X, Generation Y, Generation Z, and Generation Alpha. These are the post-war generation, capitalism, globalization, the generation born in the digital world, and the post-COVID generation. Remember, money is generational. And the old generations are idealistic. The Generation X, very materialistic. Generation Y, very self-centered, knows what they want, very authentic, and quite opinionated in new generations. Essentially, philosophy works for the first generation when you're selling to them. They can discuss politics. They will discuss scarcity. They'll discuss fixed deposits. For Generation X, it's status. It's about cars. It's about homes. For Generation Y, it's about zindagi na milegi dobara. It's experiences. Generation Z, it's about what's in it unique for me. And Generation Alpha, they just want limited edition stuff. Why is this important? Let me tell you the big reason why this is important is because you can only sell to the generation you belong to. If you are a 50-year-old IFA trying to sell to a 25-year-old youngster, you're not going to be able to be as effective as a 30-year-old IFA is trying to do the same thing. You're going to be more effective with 50-year-old clients. For clients in your age group plus minus 5, you're going to be the most effective because mentally you will be on the same wavelength. So how you decide your client segments matters a lot. You can scale your business, but if you want to do that, you will have to recruit people older or younger to deal with those client segments. That's how you can build a business for everybody if you wish to. Lesson 5, and I have lesson 7. I have very little time left, so I'm going to go a little more quickly. Personal finance in India has 5 regulators. One of the big problems we face for loans, for capital markets, insurance, RBI, SEBI, IRDA, PFRDA, RERA. But if you look at an MFD, we must attempt to bridge all of these financial needs as much as possible, collaborate as much as you can with professionals in other domains as well, update your knowledge about these products. Lesson 6 is that research suggests that people tend to invest for happy outcomes. Remember this, people tend to invest for happy outcomes only. So, SIPs for children, house, car, vacation, very happy. This AUM is always redeemed, and MFD's toughest job is to make retirement a happy outcome, update retirement to financial freedom, and retirement AUM is generally not redeemed. That's the most powerful AUM that you can build. The last lesson that I have is when you think you have thought of everything, what is left is risk. So, diversifying your investments is obviously a good answer, but diversifying income, and this is a whole new innovative thought. Diversifying income is a better answer. Can MFDs help clients manage risk by diversifying their investments? Yes. How many can help clients to diversify their income? Have you ever thought of this part? A single source of income from your life skill is the biggest concentration risk that individuals have. If you look at this, you know that, the Time magazine cover that says this baby could live to 142 years. New generations will live longer. Since 2012, adult diapers sell more than baby diapers in Japan. The second fastest growing age group in the US is 100 plus. The risk of living longer cannot be met in the traditional way that we sell investments. One of the things that we have done at PGIM, and you will find this on our website, we just loaded this 15 days ago, is we have put up a report of saying 50 different hobbies that you can monetize. Where can you learn it from? How can you certify yourself? How much will it cost? How much can you earn from these hobbies? And interviews with people who have done that. You will find, that very, very powerful to tell people how you can diversify income for your clients, not just your investments. Ladies and gentlemen, that's all I have today for your presentation. I hope those ideas were good. People do not decide their futures, they decide their habits. Their habits decide their futures. Thank you very much.